Just a few hours ago, traders on Wall Street breathed a collective sigh of relief. The latest U.S. Section 232 executive order finally landed. And that sword of Damocles of tariffs, which had been hanging overhead for weeks, ultimately did not strike at precious metals. Silver futures rebounded in response, and short-term short covering painted a beautiful bullish candle on the charts. A report from JP Morgan immediately noted, short-term pressure alleviated. It seemed as if everything was back on track. The bulls began to celebrate, believing that the benevolence of the regulators would open a new bull market window for silver. But if you were to open the overnight repo data in the bond market right at this moment, or take a deep look at the cost structure of the photovoltaic supply chain, you would find this optimism so naive it's almost laughable. Why did we all read it wrong? Because in financial markets, sometimes what didn't happen is more important than what happened. This time, the tariff stick didn't fall, not because policymakers suddenly became benevolent, but because they didn't dare to. Hidden behind this is a brutal truth about inflation, industrial collapse, and the stripping away of monetary attributes. Why did this executive order bypass precious metals precisely at this point in time? Is it really to protect free trade? If you believe that reason, you might also believe that the Federal Reserve raises interest rates to help you make a profit on your savings. Let's pull the camera back and look down at the entire macro chessboard. The United States is standing at an extremely awkward re-industrialization crossroads. On one side is the Inflation Reduction Act trying to forcibly resurrect domestic manufacturing, especially photovoltaics and high-end electronics. On the other side is the stubbornly high stickiness of inflation. In this precise yet fragile system, silver plays an extremely special role. It is not just poor man's gold used for hedging. It is the core material for photovoltaic conductive silver paste and the soul of electronic contacts. What would happen if Section 232 tariffs were imposed on silver at this time? This wouldn't just mean a rise in silver prices, it would mean the cost of us domestic photovoltaic modules would skyrocket instantly, thereby pushing up electricity costs, and finally transmitting to the CPI. This is a classic boomerang. A tariff thrown to sanction, an opponent would end up smashing specifically into the face of Fed Chair Powell, rendering his efforts to control inflation futile. So this was a forced silence. Decision. Makers withdrew the tariffs at the last minute, not because they are bullish on silver, but because they saw the extreme fragility of industrial demand. This validates the warning in the JP Morgan report that seemed understated but hid a murderous intent. Industrial demand suppressed by high prices. This is the most terrifying signal. When a regulator doesn't even dare to raise taxes, it indicates that the asset's downstream bearing capacity has reached its limit. The exemption itself is an official certification that industrial demand is on the verge of collapse. This data seems irrelevant, but does it mean the crisis is over? Since there are no tariffs, shouldn't T-silver take off? This is the root cause of losses for most retail investors. Linear thinking. They think tariffs equals rising costs equals bad thing. Therefore, no tariffs equals controllable costs equals good thing. But JP Morgan, as strategists, obviously saw a deeper layer. Price itself is becoming a killer of demand. Even without tariffs, current silver prices are still too expensive for a manufacturing sector, struggling with a global economic slowdown. There is a classic self-regulating mechanism in economics. High prices are the cure for high prices. When silver prices remain high, what will downstream manufacturers do? They sit and wait for death. They will accelerate technological iteration, trying every means to reduce silver consumption per watt, or look for alternative materials like copper. This is the micro mechanism of the industrial demand suppressed by high prices, mentioned in the report. This suppression is endogenous and organic, more destructive than external tariffs. Tariffs can be canceled, but once the technological path changes or downstream factories shut down due to thin profits, the disappearance of this demand is permanent. Let's look at the inventory data. JP Morgan mentioned that inventories have fallen back but remain high. Translated into plain language, this means the warehouses are full of silver and no one is in a rush to haul it away. In the warehouses of the LBMA and COMEX, those sleeping silver ingots are silently telling a fact. The real economy does not need this much silver. When the cost of capital stays above 5%, holding this non-interest, bearing inventory is like bleeding every single day. So how is this bullish? This is clearly an ongoing de-stocking carnage. What does this mean for the average investor's wallet? Since silver faces risks, why is gold viewed so favorably by JP Morgan? Central banks continue to buy gold, geopolitical risk hedging, policy easing expectations. What do these piled up terms reveal? Here we need to introduce a core concept, the purification and stripping of monetary attributes. In this turbulent era, the precious metals market is undergoing a violent split personality. Gold is being redefined by global central banks as a survival chip. Central banks buy gold without looking at the price or industrial demand. They are buying the security of de-dollarization and payment ability under extreme geopolitical conflicts. Gold has detached from the low-level tastes of commodities and has become a pure political currency. Silver, however, is being ruthlessly beaten back to its original form at this juncture. The continuous outflow of ETF funds shows that investment capital, which originally viewed it as mini gold, is retreating. When industrial demand is weak, silver loses its support as a commodity. When risk aversion flows to gold, silver loses its premium as money. This is why your wallet hurts. If you are fully invested in silver right now, you are betting on a boom cycle of global industrial recovery. But if you buy gold, you are betting on a chaotic cycle of collapsing global order. Look at the world now. Does it look more like prosperity or more like chaos? JP Morgan's report is actually hinting at an extremely cold, blooded asset rotation. Smart money is using the retail investors' cheers over the tariff exemption to distribute the silver chips in their hands, then turning around to swap into gold, hiding in the safe haven built by central banks. Where did the silver ETF outflows go? Part of it evaporated, and the other part undoubtedly turned into increased gold reserves in the underground vaults of various central banks. This is not just a report on metals, this is a diagnostic report on macro cycle mismatch. We thought we saw bullish news. The tariff sticked in T-fall. But in reality, what we saw was a critical illness notice, because the patient is so weak that the doctor does even dare to use the scalpel. Silver, its industrial attributes are being crushed by high prices and inventory, while its monetary attributes are being sucked dry by gold. That so-called short-term pressure relief is nothing but the brief, eerie calm on the barometer before the storm. But the story doesn't end here. Since the industrial logic is already teetering, why is there still a force maintaining silver as price floor? In this market full of gaming, who exactly swapped the cards under the table? While everyone is staring at the green candlestick jumping on the screen because of the tariff exemption, the real hunters are quietly completing a historic position, swap in places you cannot see. There is a seemingly inconspicuous sentence in the JPM Funding report. ETF funds continue to flow out. This sentence was drowned out in the grand narrative of tariffs and inventories, but it is precisely the key to unlocking the entire puzzle. Why is capital accelerating its escape amidst the good news of short-term pressure relief? The answer lies not only in fear, but in greed. This is a carefully orchestrated bull trap. Wall Street market makers love this kind of false dawn on the news front. Because only when retail investors are cheering and placing buy orders can the massive silver positions that institutions desperately need to dump be smoothly transferred to retail accounts without crashing the price. The cards under the table have been switched. Did they really not see the risk? Quite the opposite. The silence is the signal that they are building positions aggressively, but not in silver. Let's dissect the two core forces currently entrenched at the top of Wall Street, macro hedge funds and sovereign wealth funds. For these two types of players, silver's current situation is like a piece of meat with thorns. On one hand, it is cheap, and the gold to silver ratio has expanded to a historical high zone, making it theoretically attractive. But on the other hand, it is too dirty. It is covered in too much industrial dust. Under the expectation of economic recession, holding silver is equivalent to holding a call option on global manufacturing. Ask yourself which hedge fund dares to bet heavily on the revival of manufacturing against the backdrop of the Fed maintaining high interest rates, Europe falling into stagnation, and the East facing overcapacity? None. So we see a strange phenomenon. Long gold, short silver has become one of the most crowded arbitrage trades on Wall Street. This also explains the obvious sense of fragmentation in the JP Morgan report. Cold warnings about multiple risks for silver on one side, and enthusiastic praise for gold. S-side space on the other. This is not just analysis, this is legitimizing the flow of funds. Who is profiting? It is the risk-averse capital that sniffed out the industrial recession in advance, used the rebound from this tariff exemption to calmly swap silver for gold. They exploited your emotions. You thought that since there are no new taxes, the photovoltaic industry is about to explode. While they knew that since there are no new taxes, it means the photovoltaic industry is already fragile enough to collapse at the slightest breeze. They dumped the silver inventory, which not only yields no interest, but requires expensive storage fees, onto retail ETF holders who believe the bull market is here, and backhandedly swapped it for the gold that central banks are rushing to buy. Hiding in the air, raid shelter against currency devaluation. Do the regulators not know the consequences of doing this? Of course they know. But they are trapped in a maze of their own design. Let's shift our gaze from Wall Street to Washington. Why did the Section 232 executive order misfire? At the last moment, behind this is an almost unsolvable, impossible triangle. Facing the White House, suppress inflation, support domestic manufacturing, promote green energy transition. This is a dead end. If you impose tariffs on silver and related metals, you will instantly puncture the third goal. Silver is the absolute core of the conductive paste for PV panels, accounting for a very high percentage of the cost. If a trade blockade is implemented against it, America's Green New Deal will go into shock within 3 months due to exploding costs. Even more ironically, to support domestic manufacturing, the US government must provide huge subsidies. But if raw material prices skyrocket due to tariffs, these subsidies will evaporate instantly via inflation, like water spilled in the desert. So, the regulators' soft hand is not mercy, it is fear. They fear that once they pull the trigger, the cost structure of the entire photovoltaic supply chain will collapse like dominoes. This psychology of hesitating to pelt the rat for fear of smashing the vase is seen clearly by Wall Street. This also exposes the extreme fragility of the system. When a country's energy transition depends on the mood of a metal, when a grand executive order runs aground due to fear of a few dollars in cost fluctuations, what does this show? It shows that the system's tolerance for error has dropped to zero. This is the deep logic behind the surge in gold. The market no longer trusts that policymakers have the ability to solve structural problems. If they can even handle a small silver tariff, well, how can they handle a $34 trillion debt black hole? Is history rhyming? Is this just another fluctuation or the end of a grand cycle? If you open the old ledgers of financial history, you will find today a script frighteningly familiar. The current situation looks strikingly like the eve of stagflation in the late 1970s, or the eerie calm before the silver crash in 2011, 1979 to 1980. It was also an oil crisis superimposed on geopolitical turmoil, with high inflation. The Hunt brothers tried to corner silver back then, but were ultimately crushed by regulatory rules and high interest rates. Today, SU short sellers are no longer regulatory agencies, but the Federal Reserve's interest rates. The high interest rate environment is acting like a water pump, draining liquidity from all non-income generating assets. 2011, after silver rushed to a historical high of $50, it avalanched. Why? Because the illusion of global economic recovery was shattered. At that time, it was also a sudden cliff, like drop in industrial demand, that caused silver to instantly lose support, falling from a precious metal back to a common industrial metal. Where is the rhyme now? It lies in the gold to silver ratio. In a normal prosperity cycle, the gold to silver ratio is usually around 60, but now this number is climbing towards 80 or even 90. Every dramatic expansion of the gold to silver ratio is an SOS signal sent by the global economy. This means the market is abandoning production and frantically embracing survival. It is like being on the sinking Titanic. Silver represents the exquisite copperware and decoration materials on the ship, representing the ship's industrial value, while gold is the lifeboat. When the ship starts to tilt, you will see an absurd phenomenon even if the decoration materials are cheap and tax. Free, people will spare no cost to snatch up the expensive lifeboats. This is the sentence JP Morgan didn't dare to write directly in the report. We are in the few minutes after the Titanic hit the iceberg. The music is still playing, the lights are still on, but the smart passengers are already moving to the lifeboats. In this section, we tore off the warm veil of tariff exemption and saw the cold operating capital meat grinder underneath. Institutions used the cover of news to complete asset replacement from silver to gold. Regulators, trapped in the dead end of greenflation, were forced to abandon the tariff weapon, exposing the system's soft underbelly. History's needle points once again to the intersection of stagflation and depression, and the alarm of the gold to silver ratio is deafening. Now, the situation is clear. The bull's carnival is illusory, and the bear's retreat is orderly. But this does not mean we can only sit and wait for death. Since the storm is unavoidable, how should ordinary people stand firm on this rocking ship? Since silver might be a trap and gold is out of reach, where should we place our wealth? Now, let us turn off those noisy news pop-ups and forget the complex terminology in the JP Morgan report. Let us go back to the most primitive question on this peaceful-looking morning. How should you protect your purchasing power? We have dismantled the set of this grand play. The tariff exemption is just a fake cease-fire agreement. Silver's industrial demand is being slowly strangled by high prices and recession. And smart money has already completed the grand strategic shift from industrial goods to monetary goods. Some will ask, now that I know the truth, what should I do? Go all in on gold? Or sell all the silver for dollars? If investing were that simple, Wall Street would have closed down long ago. At the tail end of this chaotic cycle, no single asset is absolutely safe. What you need is not a ticker symbol, but a tactical system based on survival logic. Which indicator do we need to watch for the next 72 hours? Is it tariff news? Absolutely not. News is lagging and often customized to manipulate emotions. If you want to be half a step faster than the market, you must stare at the data that cannot lie. Please immediately add the following 3 indicators to your monitoring panel. They are the true judges deciding the life and death of silver and the takeoff of gold. 1. Gold-silver ratio. The scale of fear, why watch? This is the oldest panic index in financial markets. Warning line, 85 to 90 range. Deduction logic. The current GSR is hovering at high levels. If the GSR breaks downward, it means the market believes industrial recovery is coming and inflation is controllable. You can boldly hold silver to capture high elasticity returns. But if the GSR continues to break upward past 90 or even 100, this will be an extremely terrifying signal. It means the market has completely abandoned growth expectations and switched fully into defense mode. At that moment, silver will no longer be a precious metal. It will be sold off like copper and iron, while gold will detach from gravity. Strategy: as long as the GSR remains above 80, any rebound in silver is a chance for you to escape, not a signal to add to your position. 2. New orders component of US-ism, manufacturing PMI. The demand polygraph, why watch? Don't look at the headline PMI data. That is easily embellished. Look at new orders, deduction logic, half of silver. S-body is buried in industry. If the new orders index stays below 50 or even falls towards 45, then JP Morgan S industrial demand suppressed is an extremely subtle warning. In reality, it is demand collapse. Strategy: when the new orders index slides, no matter how much tariff exemption, good news there is, do not touch silver, because factories won T-hoard expensive silver paste in a winter without orders. 3. 10-year US Treasury yield. The system S-gravity, why watch? This is the anchor for global asset pricing. If yields skyrocket, not only will silver crash, but gold will also be under pressure. Cash is king. If yields plummet, this is gold. S-highlight moment. Note, it is gold, not silver. In expectations of panic rate cuts, only gold can catch the massive amount of funds spilling out of the bond market. Chapter 2. Countermeasures and allocation. It is not black and white. Is it time to hold cash? Or should we embrace physical assets? This is a multiple choice question about how to die. In the current macro environment, we face 2 cups of poison. One is called inflation, the other is called crash. How to detoxify? You need to build a barbell strategy. 1 left end, extreme liquidity dawn. T despise us dollar cash. In the first stage of a crisis outbreak, cash is king. Why? When silver plunges due to industrial recession, and when the quality assets you covet are sold at a discount, you must have ammunition in hand. Allocation logic: keep enough cash flow to survive for 6 to 12 months. This money is not for appreciation, it is for staying alive until the opportunity comes. 2. Right end, extreme anti-fragility note. I am talking about physical gold or fully backed gold, not highly leveraged paper gold. Why? This is your NOAA S-ARC. When central bank gold purchases hit new highs and geopolitical risk becomes the norm, gold is no longer for trading. It is for hedging the risk of collapse of the fiat credit system. Allocation logic. This is your ballast stone. Regardless of short-term price fluctuations, do not easily get off the bus. Remember, you don't T-buy gold to make money. You buy it so that when other assets go to zero, you still possess the chips to turn things around. 3. Middle cautious speculation. So, is silver really hopeless? No, silver still has opportunities, but its logic has changed. Former logic: PV explosion, high demand, surge, silver price up. Current logic: currency over, issuance high, gold too expensive to buy, spillover funds, buy silver. Strategy: if you are an aggressive investor, you can allocate silver, but you must treat it as a high beta gold option. That is to say, only touch silver when you are convinced gold is about to start a major bull market. Dawn T buy silver because of industrial demand, buy silver because of currency devaluation. This is a fundamental difference. What is the end game of all this? Finally, let S jump out of the K-line charts and take a look at the future from the height of history. What we are experiencing is not just a simple inventory cycle adjustment, nor a pure tariff game. We are witnessing the end of the Great Moderation. For the past 40 years, we became accustomed to low inflation, globalized division of labor, and efficient, just, in-time production. In that era, silver was the blood of industry, and efficiency was paramount. But in the next 10 years, we will enter a new era of high inflation, globalization, and geopolitical fragmentation. In this era, efficiency gives way to security, and profit gives way to survival. Physical is king. In an age where trust is scarce, only the physical objects held in your hand are real wealth. Wealth in digital accounts can be zeroed out at any time due to sanctions, internet blackouts, or banking crises. Deindustrialization pains. The West SRE. Industrialization is destined to be expensive and painful. In this process, metals like silver that overly rely on industrial expansion will undergo a long value revaluation. It will fluctuate violently. But this is just a death struggle until a new supply-demand balance is established. Currency reset. All central banks are buying gold, which means they are all preparing for that day. When the existing fiat currency system can no longer carry the massive debt, gold will return to the negotiating table as the final credit anchor. So the final advice is extremely simple. Do not try to earn the last copper coin in this turbulent market. The JP Morgan report is just the tip of the iceberg. It covers up the huge undercurrents beneath. When the Section 232 tariff stick is undecided, and when industrial demand is suffocating in inflation, what you should do is not rush in to grab the rebound. What you should do is sit on the sidelines, hold tight to your gold and cash, and watch those greedy gamblers scream on the silver roller coaster. In this era, surviving is the highest rate of return.